Again, it's great that now we don't need Melvin Capital. We can actually just do it as a community, and it's much more reliable because an AMM doesn't turn off when the market gets super volatile. An AMM always provides that liquidity.
Welcome to XXIM Podcast, your home of decentralization. Today, I've got with me John Wooten.
Thank you, Ankit. Great to be back.
Awesome, John. Look, today we have a very, very exciting topic, right? I wanted to discuss with you the difference between decentralized exchange. Explain to us what are the differences and how they operate. What are the pros and cons of both?
Of course, Ankit. The AMM one is certainly what more crypto native people are likely more familiar with. It's that system where you have whatever token on one end, and then it's contrasts it with another one. The term automated market maker is trying to generally automate the trading mechanism. And that was sort of the original idea, is that you could have the constant product liquidity pool is sort of the first example. And all that jargon means is that there's 100 of the token, and normally it's versus like some very stable reference currency, whether that's a crypto, whether that's a fiat stable coin, something like that. But you'll have the value pegged to something that people will normally value things against. And then if you want to trade, if you want to like buy the token, then you can send money and you get the token in return, and it adjusts the weight of the two items in the pool and charges a spread in the process. Just like in a normal market, if you have an order book with the bids and the offers and the difference between the best bid and the best offer, that's the spread of the market itself. And so the AMM, in principle, at the start of what most people are generally familiar with, is automating that process so that you pay a small spread, normally it's 30 basis points, and then that goes to that is a fee that's added to the funds in the pool. And so people that originally they deposit the token and they deposit an equal ratio of whatever it's pegged against, they can at any point withdraw their token and withdraw the funds is pegged against, and then they'll receive a little bit extra when they withdraw than what they deposited. There's some risk to it, like there's impermanent loss is a very material part of, it's like market making is risks. The risk of a normal market maker on the bids and the offers, the risk is that you get stuck with a position and the market moves against you and you take a loss, right? You buy to fill a trade, you can't find a seller and the price goes down, you take a loss on it. And so it's the same thing with automated market makers. If it's a very volatile market, if it's going up a lot, it's going down a lot, it's harder to make a market in that instance. And you might have a loss where when you withdraw, you might have more tokens, but they might be worth totally less than what you put in.
So John, let's break it down. The AMM itself started in 2017 by Bancor team, I believe, right? So they were the first one to pioneer this thing. In 2017, we didn't have a lot of DeFi protocols back then, right? It's a while back, right? And then 2021, as you explained, Uniswap really took on this thing and expanded. Based on my understanding, their innovation was, well, now to provide liquidity, anyone who's involved in the project can put their tokens and earn some rewards as an LP. And that really took off because now people are like, well, we are long on this position. Why don't we just provide liquidity to the protocol and also earn rewards? But at that time, I think, as you mentioned, right, people didn't realize that there was a concept of impermanent loss. I think in 2025, we are certainly moving towards, or at least the market is moving towards, the Orderbook-based DEXs, right? Because of these few, perhaps not well understood concepts like impermanent loss, especially in the volatile markets, right? When your token goes up, you're losing money by providing liquidity, right? Because of impermanent loss.
Yeah, Uniswap, certainly the first one to scale that original idea posted by Vitalik, and the one that had the attention of the SEC and the Gensler administration for a lot of pretty good reasons.
Yeah.
Just for everyone's context, when we talk about limit order books where you're really specifying exactly what you trade at, that was the de facto standard for 400 years of financial markets. This AMM concept really was a new innovation from Web3. And before then, it was just manual. People, they would put their bids, they put their offers. They have these incredibly complicated computers that will adjust them in microseconds, nanoseconds sometimes if they want to arbitrage certain things. But of course, that's not possible with blockchains, especially blockchains in 2017. I mean, you weren't the most popular ones. You're looking at very slow confirmation times and very expensive transaction fees. So every single time you have to change your bid to a penny more or a penny less, like that could cost a lot in gas. So John, the AMM as a contract was one of the first times that you could really do that with just one transaction doing 50 trades or something.
Right. And the key I wanted to highlight here is in 2017, when Bancor launched it, it wasn't for normal retail user. It was designed for institution. And it was designed specifically for institution. They will send them out forms to sign that they have the money to provide the liquidity. So the concept was, hey, you if you have capital and if you want to get into the blockchain space, crypto, provide liquidity, well, there is a way to do so now. But it wasn't for normal retail to provide liquidity. It's a very different background, which perhaps most people don't know.
Yeah, it's a way to earn yield on crypto that sits there. Whether or not it's better than buy and hold, it depends on the market conditions, right? But it's definitely the core of a lot of on-chain lending products that generate yield without the traditional banking system. They're generating that yield by extracting these trading fees. And you look at these contracts on some other chains and they compete with each other for that liquidity. Liquidity is the centrality of the argument. Just like on the legacy market side, the bigger institution you are, the more maker-taker is something that has to come into this conversation at some point. So we might as well introduce it now. Yeah. The idea that you get paid to deposit liquidity and you get charged a fee when you take out liquidity, that was pioneered by some of the very early competitors to the New York Stock Exchange. When computers were first introduced, there are some historic cases of these people just spinning up computers that ran order books, not dissimilar from some of the L2 order book chains or the external mesh network order book systems.
Right.
And they would just charge a lower trading fee than the fixed price
maker-takers. Sorry to cut you off, but I think
So
most people, I think, I like this format more. So what is a maker-taker fees?
Well, it's the core of, especially these central exchanges that many are familiar with, of their pricing model. And it was pioneered in the early stock market days. And the idea is that if all of the liquidity, if all of the sell offers and all of the buy offers on a limit order book are at your private computer central place, then people have to trade with you because you're the market. Yeah. And so the ingenious invention that these original ATS founders had, specifically Instinet, was that they didn't have anybody that wanted to trade on their little computers. So they would pay people to send their orders to their computers and to build up a book of liquidity, a book that eventually became statutorily required in America, that if the price there is better than the exchange, you have to trade there. And that idea of paying people to bring all of their liquidity to your exchange is what funds rebates for payments for order flow, if you're familiar with the stock exchange side. It's a new line of business for institutions and brokers to receive money just for sending their orders somewhere. And when someone trades against something, so if you submit an order to the order book and it doesn't fill off of an existing order, it just goes and it adds liquidity, it just sits there. That's when you're the maker. And normally basically all the crypto exchanges will charge you fees, no matter if you're a maker or taker, but they'll charge you less of a fee if you're a maker, at least on most of the platforms.
Well, maker is providing the liquidity, right? That's the key here.
Maker and a taker executes against it. They take that order.
Taker is taking out. So taker in most cases, not every case, but most cases will be retail, to simplify it, right? And especially in crypto space, they're a big institution, but they perhaps do OTC and other deals. So maker is the one that's providing the liquidity.
Well, the original system, what they would do is they would charge the guy who ticks from the order like 3 cents, and then they would pay the person that made the order 2 cents, and they kind of kept the spread and the difference. But when you bring it into the AMM concept, where it's just this one giant conglomerated pool of funds that everyone can deposit into. It's more of the fixed fee model is common,
Right.
is the most common one.
That's true.
So it's it's
That's
just
true.
different because you're not really like, there's no orders, right? There's nothing that executes against it. You're executing against the entire pool, and you're only paying that fee. It's not like you pay money to deposit into most liquidity pools, right?
That's true. Thank you for clarification. And I want to also say that, the way I think about these two models, like they both are decentralized, right? I think that's why perhaps everyone gets confused. Well, what is decentralized? They both are decentralized. They both are good. But because they both are decentralized, there is always a confusion about what is better. But coming back to this, the concept of maker taker, the way I like to think about it is, for a AMM based decentralized exchange DEX, you are swapping a token. You're not really, there is no really bid and ask. There is no, there is a slippage and stuff, which is equivalent to perhaps the spread. Maybe not, but I'm just doing a very simple comparison. But
Yeah.
there is no real bid and ask. It's just a swap that you're doing versus an order book.
Yeah, well, you pick a price. I mean, that's how issuers, normally some of these crypto things, they'll deposit 500 grand from their initial investors into a liquidity pool with all of their tokens on launch day, and that'll be their IPO or ICO mechanism, whatever. But in a normal market where you're a normal company selling stock to the public, you sell it at a price, and that price, maybe it comes from the market, but it's a price. And priced orders are the basis of efficient markets. The order books, they are just the foundation of all capitalism, is being able to express exactly where your interest is on a perpetual basis. People can see, and you build up a market depth. You build up a depth of all these different orders that build up the book. And the AMM is sort of like this awesome addition to it, but you do need limit orders so deeply.
For AMMs to truly work, you need a price mechanism for it to peg. It comes through arbitraging. It comes through oracles that arbitragers use to repeg the price based on the market price. So it becomes a complicated issue.
Yeah, it's like a market order only option where you can't specify your prices, and and that arbitrage is key for a lot of these projects, because a lot of the tokens they trade on 50 different exchanges. I mean, look at American stocks; they trade on hundreds of venues, and so the like 90% of the volume a lot of times can just be arbitraging between different contracts in different locations, and that just it's unfortunate, because the person that's paying for that is retail, right? This is the institution making that little spread difference between things. I've done it myself on chain. I made a little bot, set it up, ran it on a server, and it just starts creating returns, making markets and arbitraging between different venues. And it's not like awesome, because all that money, all that extra fees, all the billions of dollars that the traditional market making wholesalers we know of on the security side, that money is coming from higher spreads. It's coming from a place has it at $10.01, and this place has it at $9.99, and you're only going to get one of those prices, but somebody's going to make the arbitrage, and I think, and then the fragment. So
indirectly, what you're saying is AMM models are very inefficient. They serve a purpose, but they're very inefficient themselves, and they have to rely on arbitragers for them to work. That's the key, I think. I want people to learn that AMMs without arbitragers will fail.
Well, it's an unfortunate symptom of a much larger challenge in the whole industry. I'll take Ethereum as an example. The slippage on a liquidity pool, on an AMM, is determined by the size of the deposits, right? So if you're trading at $100 and the pool has $1,000, you're going to have a very big price impact. You can move it 10%, right? But if the pool has $50 million and you're trading, a couple $1,000, it's not going to budge. It's not going to change the ratios very much. So they get a much tighter execution on top of that spread. And so the bigger challenge is that these contract implemented liquidity pools naturally compete with each other, just like alternative trading systems in the stock market world compete with each other for liquidity. When you have your crypto exchange order book with token versus coin, you're competing with every other crypto exchange that has token versus coin as a trading pair to get the fees, to get the users, to get the volume. And so the larger structural challenge is that the volume and on the crypto exchange example, consider you're just an investor who wants to make a trade. You only really have that one place that you're going to, whereas the big institutions have accounts everywhere. They're arbitraging at every minute. I mean, I talk to them and they have like these lightning fast server nodes that they'll co-locate at the crypto exchanges, which aren't regulated, and they'll get the microsecond differences that you see in normal markets. And so the bigger challenges for fragmentation on Ethereum, it started off with Uniswap being the dominant platform everyone used for exchanges, but over the years they've got less and less and less market share, and there's more and more and more competition, and they're all trading the same coins, and all that does is shrink the size of the assets in the pool and increase the volatility, because now it's not all in one place. Now you need to use XYZ proprietary routing algorithm to send your order to this liquidity pool and half of it to this liquidity pool and more to this one, and you got to spread it out over 5 places, and it's 5 times harder to route and to send the transaction. And that's the larger fragmentation challenge that does increase the slippage.
We are discussing that AMMs, the way they work today, right? The efficiencies from giving people access to this technology and true innovation that happened, where people now can contribute rather than just holding their tokens. They can contribute, they can participate in this ecosystem and earn rewards, right? With AMM, they can deposit their tokens and earn rewards. It seems like a very good thing, right? And then we're discussing obviously the flaws of the system, perhaps the things that we now know 4 or 5 years later. So let's move this dialogue onto, specifically onto Orderbook. So Orderbook is the solution. That's what you're saying, or Orderbook is a parallel stream of innovation that's happening that is perhaps better in some cases and inefficient in some cases. How do you see order books today? Are they especially in crypto where liquidity is fragmented?
Well, that's certainly essential to the challenge, because where are the order books? I think having a truly decentralized order book really is the key to giving masses of people real savings and retirements, having a universal market that really lets everyone decentralize capitalism. Because again, the order book is where markets really get made. It's what the price mechanism is entirely based on in traditional markets and in any asset. It's more efficient to have the ability to put what you want to sell at, to have the liquidity there and then execute it against, instead of everybody racing to fill up a very limited block size to get this one fraction of a second of an execution against the liquidity pool before anybody else gets the liquidity pool. And so you bid your fees up super high to be first in line. And it's just, if anyone told a company that's about to IPO that they need to put up half the money of their IPO up front to fund the liquidity pool to start selling their shares, it's just a joke. Okay, it's not going to happen.
But they can ask their community, right? The shareholders. I mean, I guess there's a pre-shareholders, so you're talking at the stage of IPO. Right, so it's the chicken egg situation you're talking for the AMMs, that they need to put up capital up front to even start trading on AMM.
They do, and there's nothing wrong with it. I mean, it's just market making, right? And I think it's awesome that we can democratize market making. You can participate as a market maker by clicking 2 buttons and not having to run your own computer trading bot. You can just join into it. But it's definitely an addition to the market system of having priced orders that's existed for centuries.
It's fascinating because I know, AMMs work really well when the market is more stable.
Yeah.
Right. For, I think, protocols that use likes of Curve, I believe that because they trade the stable coins, there is no volatility as such on stable coins, and a LP, liquidity provider, for Curve can earn rewards by providing stable coins, right? So I think AMMs stop working when there is volatility, which is typical for non-stable coins. But for stablecoin, I think So I guess what I'm getting to is, there are use cases, very specific use cases that you mentioned in case of issuer wanting to put up coins and create market, or shareholder wanting to control their own market making. Makes sense, right? So just again, moving more into the order book side. So order books haven't been around on the blockchain side, right? It's a relatively new concept, maybe a couple of years, 3-4 years, but for sure, not many people are aware of it in the blockchain space, in the crypto space. And now I know there is a definite move towards order book decentralized exchanges. Why we haven't really seen the innovation, if it's such a simple innovation as you're explaining it?
Well, the curve instance, the stable coins between each other is the classic example of a liquidity pool, an AMM, that is just so easy, and it's like the low hanging fruit of extracting yield from crypto assets, and such a simple implication. I've seen in my own trading the AMMs compared to the order books for stablecoin swaps, and when you introduce a real order book, it gets interesting because people will bid at a spread that's tighter than the AMM. And I think that's the key to remember here, is that the AMM really is just automating the market making. And it's a tool for trading, but it's really a tool for market making, a business which has been around for eons. And it's great that now we don't need Melvin Capital. We can actually just do it as a community. And it's much more reliable because an AMM doesn't turn off when the market gets super volatile. An AMM always provides that liquidity. And so it's much more stable. You're not going to have like a flash crash from it. But there's like the market making has its own risks, and you don't take those risks with the stablecoin pairs, which makes it the more first-hand example. But it's a little bit more interesting when you have like real assets, because you're making a market, and if the price moves against you, you can lose. In terms of the order book development itself, I mean, Stellar has had a decentralized order book since 2014. They were really the first ones on the scene with it, and
Really? Okay.
had just an exceptional implementation of it. And they added that AMM functionality to the base protocol later, once the AMMs had sort of proven themselves as a useful tool, because that order book really is the key of it all. And like I said earlier, the scaling limitations of early blockchain systems just didn't permit having an order book. You had to have it as the AMM, because it's really the only way you can timely trade these assets, when you have to have such high transaction costs. And there's very, very fast crypto trading by the time that Uniswap came out, very quick crypto trading on central platforms. So if you were trying to do limit order books with a 6-minute block time, and back in the proof of work times this was, you were just going to get your skin, you were going to lose a lot of money because people would arbit very, very easily.
Right. So 2014, Stellar already had this Orderbook-based decentralized exchange. And so, I guess why it hasn't taken off. Like, we're talking, they were very early and pioneers in the space. But most people still don't know about the order book. I mean, I'm talking about the concept, let alone actually using the blockchain, right? A tiny centralized exchange, not even the top 50, perhaps does. I know nothing about Stellar DEX, so I'm not speaking for them, but I'm just assuming here that a small exchange will do higher volumes than perhaps any of the order books that exist today on decentralized exchanges.
Well, to answer the first part, the Stellar really has always been so far ahead of the curve on trading and liquidity and markets, largely because, Jed, one of the chief co-founder, one of the early founders, literally built the first Bitcoin exchange. And if you go to that product or any brokerage account at any central legacy financial platform today, you're trading through an order book. An order book is how trades happen in the entire financial system. And Jed actually really innovated with some of the first visualizations of complex market depth in that original Bitcoin exchange, which has quite the storied developments after it was sold off. And I think that a lot of those insights and a lot of that specialized knowledge on market infrastructure was carried into their work at the aforementioned coin I won't name, and then at Stellar. It's so hard. I mean, I looked through the archives of some of the order book work that was done by so many developers that released this initial version in 2014 that had order books built into it's really just mind-boggling how far ahead of the curve they were on on-chain trading. And then, of course, the consensus method, which is very important to any discussion on order books. It had that fairness that you need for the transaction handling, and it had the speed of 5-second ledgers that allows for reasonable trading.
Yeah, just disclosure here. You are building on Stellar network. It's a decentralized network, and you are a proponent of the Stellar DEX. And I just wanted to get that disclosure out the way. So there are a few different order book based exchanges exist today. Why? What are the differences, first of all, between them, right? There is DXDY, I mentioned. There is BitShare, I believe. There is also Carbon that's built by Bancor team. So there are a few different ones that exist.
I argue that the Stellar Decentralized Exchange is the only free market on the planet. It's the only distributed market that anyone has equal access to and can submit transactions on the base layer of the blockchain. They get stored across a distributed network of nodes, and very crucially has no central control. It's part of the actual blockchain protocol and the consensus rules around it, and it's based on the layer 1 transaction rules for how everything executes. I would challenge you, is very, very playfully, and let's go into it. Any other platform, that's even close. The incentives, the tokens, let's go, let's do it, because I see absolutely no other option.
Right. Like, I mean, you could be right, but I haven't studied each and every order book based exchange. But I do know some of them there are differences, right? So let's define the differences that I can see on the surface level, right? On the layer 1s, how they process them. I believe Stellar, you put everything goes on the layer 1. So even the orders, bid and ask, are processed through the layer 1 itself. It's part of the ledger, right? To simplify it without going into detail. And some do off-chain order matching, and then the settlement is on layer 1.
Yeah, as soon as you take the order book off chain, there's so many problems. I originally contemplated this challenge 5 years ago in Wooten.link/thesis, where it was this whole quandary of how to remove the challenges of centralization in the order books of legacy markets. And there's no way around it. When you put one entity in control of what are the orders, who has access, who updates their orders the fastest, where is the matching happening, as soon as that's in a private entity's hand, there's a very direct path that I've seen so many projects start going down that looks exactly like the early days of the alternative systems that were competing with the NYSE, where you have a proprietary interest, whether it's a central business or a community DAO that receives that proprietary, because liquidity is a public good. An order book with the pricing information is a public good. It's what lets anybody in the world instantaneously know how much they should sell their gold for. It's the spot price. It's always the spot price. The price mechanism of the market itself is a public good that needs protection. And these central intermediaries of yesteryear on the securities side alone have bastardized completely the entire free market concept of people putting their trades against other people's trades because of all of the secret dark pool venues that let a select group of insiders get a backdoor deal at a better rate than anybody else on a fungible security. And I see that exact same process in the operations of every single off-chain order book or matchmaking, trading, liquidity venue.
If the DEX does order matching off-chain, the routing part off-chain, but the settlement happens on-chain, through layer 2 to layer 1 or layer 1 directly, but the order matching or routing happens off chain with the proprietary system. What do you like? Because I see you are a big proponent that order routing, order matching, and order settlement all has to happen for a true decentralized order book-based exchange to work. Not just work, but to be an honest player in the game, right? Um, but there are players in the game today on different chains that are doing part of it on. I mean, everything goes on chain, the settlement side, right? All the order book-based exchanges will settle on the chain eventually, but there are just different mechanisms within it.
Yes, the routing, the matching, that's where this liquidity becomes centralized.
Yeah.
I'd argue any of the off-chain platforms, because I've studied them and watched them from the very early days. Any of the off-chain platforms today have significant investment in them, whether it's from venture, whether it's from community, whether it's from Wall Street on some of the shit. 60 recommend.
Right.
They have very explicit profit motives. And I've seen protocols go from a free open source technology to one that is a centralized API charging subscription fees and basis point fees. And they all of them have maker taker if it's a limit order book. Awesome thing with the Stellar DEX is that all of the order matching code is part of the core protocol, open source, free software. Anybody can go and look through exactly how the transactions work. Any changes need to go through the entire network changing it. And unlike some layer 1 blockchains that literally have maker taker fees, it's a free market. You submit a transaction, all you're paying is the very minimal gas at spam prevention, and there's the whole consensus around that and how the transaction throughput and thresholds work for any other operation, whether it's a transfer or other. There's actually really cool things that you can do when you have the order book. You can like send one asset and someone receives the other asset, and it's all very, very efficient and cheap. It's actually better execution that you would get on a central exchange. But yeah, the point is that it's a free market where not only is nobody controlling whose orders go where and what matches with what, it's all algorithm, price, time, priority, but also it's actually free. Like once your order's in there, you're not going to get charged XXX basis points as a maker, and that just doesn't exist elsewhere.
Right, I see. So there are no maker taker fees there on Stellar.
There's no profit motive.
No profit motive, right? So,
and you can't have a profit motive with a truly efficient market.
So do you see then that because there is no profit motive, do you see the lack of liquidity because of those things? Because if I'm providing money, like being the market maker, I'm there for making money. I'm not going to risk up my capital. I guess the way this institutions work today, right? I want to provide liquidity. I want to make money.
Well, you can still make money. It's just the exchange isn't making money. And that's the big shift. Since launching about a little over a decade ago, the Stellar DEX has done $28 billion in transaction volume in US. And so it is extremely liquid for assets on the network. There's just not a whole lot of assets on the network to trade against.
Right. So do they support non-Stellar assets?
It's an L1 blockchain. It's got to be the token on there. Like, there's USDC and all of the block transfer syndicate issuers are native tokens that go through the same DEX.
Yeah, but it wouldn't have the bridging mechanisms to bring the non-native tokens, or does it?
Yeah, there's a lot of infrastructure built around that in Stellar, and it's one of the core goals and objectives of everything there. And it's done through issuers. It's done through, like you would expect with the custodian process. Whether it's a trustless custodian or not is a different thing. But it's the same thing you would expect on other chains where it's just native bridging, right? L1 to L1 mirroring is a whole there's been a lot of work there. Like, oopsie, we had all of the money, but man, there's another agent which I won't name, but they used this protocol that had an L1 to L1 bridging hack of like billions of dollars. And who backs that out? VCs back that out. The money from those that want to profit from these systems. And that's the thing with the order book, is the order book should just be something that no one needs to profit from. It's just a trading vehicle.
Even once you have this order book based decentralized exchange, you still have issues like bridging different assets, bringing over to your protocol, right, blockchain, because the bridging is, I mean, the biggest bridges are centralized, if you believe it or not, but they are unfortunately today centralized. Perhaps one day they will become more decentralized. You can have simple bridges, one chain to another, but to make it cross-chain bridges, you have to have, some sort of validation and some sort of blockchain of your own. So that becomes the centralized point in between. And as you say, like, a lot of VCs are backing it, a lot of money going in. Part that we haven't got to is, are there any inefficiencies in the order book itself, or order book based decentralized exchanges, right? I mean, we've talked about lack of liquidity, perhaps because you have so many order book based decentralized exchange. In one way or another, right, we can argue which one is better, and I'm sure every chain proponent will come out and say their order book based exchange is better. But lack of liquidity, but that challenges across AMMs also, so it's not a new challenge for order book. Are there other challenges that exist today on order book based exchange?
Well, it's an open question if we'll have a lot of them that actually get liquidity, because as soon as you have the liquidity, it kind of is a natural monopoly. And that was one of Jed's insights from the early days of running that exchange, was that you can kind of completely control the entire market and be the market, just like Valve is the market for PC video games. If that one particular exchange never went down, it really legitimately could be the market for all Bitcoin trading, in the sense that it had every single trade, every piece of liquidity. Order books are just incredible. I spent practically my whole life, that I might, developed life I can think of, in the order book market, whether I knew it or not. My first experience with them was trading video game items in Team Fortress 2, where you would go into an open outcry market and you would tell everyone that you're selling this at this price. And you would have, peer-to-peer trading like that. And the price, that is such a fundamental piece of capitalism that needs to come from a decentralized group of investors that decide what they want to pay for something, not some behemoth machine that picks the price out of thin air. It's fine for market making, but it's not good for price capital formation. It doesn't work for price discovery, and it's most certainly not an efficient market, a free market that puts everybody in the driver's seat of their futures, rather than the driver's seat of some omnibus pool of capital sitting on chain. It's just the markets are order books, and a lot of people don't understand what order books are, and it's completely understandable. But these are the systems behind everything you see around you having a price. It's people saying that they'll pay something or they'll sell it for some price, and they come to an agreement. They sort of negotiate down to a rate. And I have a lot of, more recently, I've seen a lot of private transactions on proprietary exchanges trying to execute some stock purchases for companies that are going to go public, for some work on my SEC comments. And it's just horrible how inefficient a proprietary order book is, where there's a $5,000 transfer fee every time you want to make a trade, and each instance is a private negotiation with the specific seller, and there's back and forth manually, and it's just night and day between a truly efficient market that has everybody's prices, everyone's orders, and as soon as they cross, that trade settles atomically, instantaneously.
Yeah. I think, just like you put it, I will even simplify it. The way I understood it, it's like eBay for trading, right? There's a buyer, there's a seller. Trade doesn't happen if there is, the price difference. The trade will happen when they come together, right? On an eBay being the perfect example, which most people will understand it, right? You can't sell an item if there is no buyer. But if the buyer says that they're willing to pay more, right, the trade will happen. So I think that's and another point you mentioned is amazing, that everyone in the crypto ecosystem, perhaps, that I have spoken to, believe there is a true price discovery. There's a supply and demand equation work. I think we just don't realize there is no supply and demand in anything today, except in the financial markets. In the traditional systems, yes, but in the financial market, there is no such concept as demand and supply. It's all broken because of these, all the things we discussed today. So, but yeah, John, this is amazing discussion. I'm quite happy that we had this long discussion. Of course, I think there are a few things we left. Like, I want to understand more on the routing side of these order book based exchanges, because that matters. How they work, how efficient they are, how smart they are. What goes on the layer one is a second topic I would like to discuss, because it's a topic that why certain layer ones are designed this way, and then other layer ones cannot even comprehend. And what goes on the layer one. So there are some follow-up discussion, but I just wanted to thank you for your time. Thank you for being here. Thank you for being this amazing guest as always. So thank you, John.